Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
It's Money on Tap's insightful Summer Sector Series, diving into the hottest investing sectors for the season. Each week exploring a different high-growth industry, analyzing major players, market trends, and emerging opportunities with expert guidance to make smart investments all summer long. Your summer school session starts now.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we're glad you are aboard with us today. And we're going to spend really the majority of our time today digging in to technology and investing, how to invest today in tomorrow's titans. Gosh, it's going to be so much fun. We've actually just in creating this show, the show before the show, where we spent an hour or more at least really kind of digging into the topic and getting this into a format that's consumable for you, because that's really what we're all about, is having some fun with the topics that we go through every day as financial planners. And this is going to be a really fun show for us to dig out for you. I'm Seth Krussman here with Ben Brayshaw, Dan Mickelin. And before we jump in there, please subscribe to the podcast and share it with a friend. Be generous. You know, that's what life's all about. And we appreciate you doing that. When you do that, just make sure that you send us a quick note at info@yourmoneyontap.com, because we want to send you out some Money on Tap gear. With that, you guys, how are you today?
I'm doing great. I was thinking very similar thoughts as you were, Seth, and Dan. We were talking about all sorts of stuff. So I kind of pre-phrased this show as the nerd show, because this is where we get so much deeper into some stuff. I mean, I honestly would feel bad for anybody sitting in the room with us, listening to us, trying to understand what we were talking about. The level of detail we were getting into and saying, that's not going to fly on the radio. So this is going to be a good show, but I think we're going to get a little deep. I want to prepare people for that. But boy, in the technology world, that's what you need.
Yeah, I'd say this is one of those shows. I mean, a lot of times we'll kind of go in kind of higher level, broad topic, things that we try and make it easily digestible. And I hope this show ends up that way. But if there's one show I'd say, hey, if you're listening at home, grab that notepad and pen. This is one of the ones you're probably going to want to write a few things down. If you're serious about technology investing and you're looking for some insight today, this is the Note Taker Show.
Agreed.
Yeah, speaking of show notes, we should probably do a little better job on that ourselves, of creating some reference points for you as you're listening to things here. You can go onto the podcast and dig in a little deeper to some of our past shows. We do a lot of shows that are show one, show two, as we walk through some of the designs that we work through in our financial planning. If you didn't know, that's what we do. That's all three of us, Brayshaw Financial Group. And it just happens to be Brayshaw comes from, let's get into the etymology there. Brayshaw, where does that come from? It's Ben's last name, in case you didn't get that part. He starts before Dan and I in the alphabet, so he got lucky and got the name.
I had to play one role in the business.
Yeah. Without further anything, it's time for Money in the News.
Coming to us first today from Fox Business, Danielle Genovese. Ozempic versus Krispy Kreme. Wall Street firm bets weight loss drugs won't beat donut sales. And, this title just jumped off the page a couple different ways for me. And I just don't think donuts when I'm talking about investing or reading about investing. So this was definitely an attention getter. And then some of the quotes from the CEO in here I just thought were just really funny. I think a lot of people out there in pop culture and society, this Ozempic weight loss drug has kind of taken the world by storm. And for a period of time, it was major news in the market, not only for the manufacturer of that drug, but as well what kind of impact it was having on fast food and diet trends and And this level of heightened awareness and concern that just kind of popped up about, the different things we consume and what kind of effect that can have on us. And as it made its way into the investment world, some of those companies, began to suffer through that temporarily. But, the Krispy Kreme CEO is making the long-term bet that, people still enjoy their sugar. They're going to want to get back to things that they enjoy. We've been through all of these, better eating, diet trend cycles, and still the indulgent snack market is holding in there strong, which is a sector I never heard of, indulgent snack market. But he has it measured at $69 billion in the U.S. annually, which I thought was a pretty powerful number. Chappelle, I believe, is the name of the CEO. Don't be the person bringing a vegetable platter to a 9-year-old birthday party or an office gathering.
Oh.
Yeah. Bring the donuts. Bring the donuts.
Well, I got to tell you, I didn't know it was a sector either, Dan, but we play in that area a lot. So breaking it down, I'm not going to take a weight loss drug, but I may frequent a Krispy Kreme here or there. And I think it's interesting that we all know how to lose weight. Eat less, be responsible, don't have sugar. But this is all about just, filling the void of this. And I think the truth is that, we're a wealthy nation and we get to choose our Krispy Kremes and we do it over time. I don't even care about Krispy Kreme, but that's not my vice. But my vice is sugar. So I don't know. I don't invest in Krispy Kreme. I don't invest in a lot of stuff like this. But it is interesting that there's really that much betting on the snack market versus the weight loss drugs.
I'm a Dunkin's guy myself. If I'm going to eat a donut, it's going to be a Dunkin's donut. There's only 2 things I can recall in my lifetime from a food perspective that when they came to New England for the first time, there was those lines out the door. You literally couldn't even get into these places. It was Krispy Kreme, one of them, and Chick-fil-A, 2 restaurants that were forever huge in the South and other parts of the country regionally, that when they finally made their way to New England, it was like everybody stopped and had to go, and there's massive, massive, massive lines. Chick-fil-A, I love it. Krispy Kreme, I didn't get it. Way overrated.
That was going to school in Virginia for Ben and I. Remember when the Krispy Kreme came there, and it was here too. It was the Chick-fil-A thing, just like you said, and the Krispy Kreme. Those were the 2 I remember where people just went nuts over them. And actually, they were already there in Virginia. And I just couldn't believe it was such a big deal. These are one of my things, you guys. I got to tell you, this is a place where I can spend a lot more time than most people. By that, if we happen to get a dozen or a couple dozen of donuts, you might as well just write the whole day off for me, because I'm not going to go far.
Sugar coma coming.
Oh, I love it. Speaking of, Donut Palace, shout out to Safu. He's one of our clients that makes the donuts. And there's hands down nobody better in the industry than him. So if you're out here, that's where we're going to go, people. Besides that, we might actually take a trip a couple hours away to one of my favorite places as well. But it's a good donut. I mean, like a really, really good donut. I'm over the moon about that. And speaking of over the moon, not speaking of over the moon, GM announces a new $6 billion share buyback, now expects to produce as many as 250,000 EVs this year. This is Yahoo Finance that is coming to us from Pras Subramanian. A really fascinating story around the EV market, where we've been watching what's happened as Tesla has tumbled, and there's many other players, including this Chinese kind of companies that have been knocking at the door here. But GM has really taken a bounce here and announced that its board-approved new share buyback plan to purchase $6 billion of GM's outstanding common shares is in addition to the $10 billion accelerated share repurchase program it announced at the end of last year, which also coincided with its plan to increase its dividend by 33%. Boom, boom, boom. That is in the makings of some really cool planning going on.
Yeah, that's a couple of real good indicators, and this isn't a suggestion to run out and buy GM by any means, but can't recall hearing such good, exciting news about an American auto manufacturer in a long time. 2 massive buybacks and a dividend increase. Sales are increasing. They've found the point, it's also referenced here in the article, where they believe they can actually be profitable in the sales of some of these EVs, which has been a trick, particularly for most of the domestic producers and, kind of legacy American companies. I think Tesla's had a handle on that for some time. But the sales are just really just picking up, and I think they've picked the right price point in the market, and that's part of the point of the article as well, is they have the cheapest EV out there that has a 300-mile range, and the audience has responded to that, whereas EVs in general have been lagging. GM seems to have, although it took their time, they were last to market with an actual product, but maybe that's proven to work out well for them.
GM was kind of hit its bottom for the last 12 months, which is pretty low. It's like close to 25, and it's trading at close to 50 right now. So you've almost doubled your money if in less than a year if you happen to buy on the bottom in October, November area. The market had pulled back pretty hard back then at that point. I mean, we actually made some pretty solid investments in our portfolios, and that GM was not one of them. I don't know. I'm just not between the amount of pollution, and we were talking about this today, like this is the amount of pollution from lithium batteries, the fact that a lot of these electric cars, once it's like 32 degrees or less, you're like dealing with troubles with the batteries anyways. I just don't know what kind of long-term our grids can't support them. It's just there's so many fundamental problems with all of this stuff that even if they do sell 250,000 cars, it's like, man, how are we going to support all these things? I mean, and we've talked about this. Like the only way to bring, and we've brought this up on other shows, the only way to bring the power to the station is nuclear. I mean, nuclear is this whole clean nuclear movement and all this other jazz, which is probably just a rephrasing of the same thing in a smaller rod. But, it's like and a hair less pollution maybe. I have no idea. But we just don't have enough power to drive all of this stuff. It's really, I think we've put the cart way before the horse, I think, on the whole concept of this. I mean, if you're driving an EV car, you're in Florida and your whole house is powered on solar and you're charging that thing with solar panels, I applaud you. Like that's fantastic. I don't applaud the fact that those solar panels one day will pollute some massive amount of earth that we don't even know how bad it is. We just know it's super bad. So like even all this stuff has to be analyzed.
Yeah, one of my favorite images is the charging station for your electric vehicle out in the middle of nowhere, run by diesel generators. That's going to do it for Money in the News. And when we come back, we are getting into some tech talk, investing how. Let me try that again. Investing how to invest in tomorrow's Titans, you guys. Cannot wait to get this show going for you. Don't go anywhere. You're listening to Money on Tap. We'll be right back.
Are you looking for personalized guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are in Tech Talk, how to invest today in tomorrow's Titans. You guys, this show is one of those that if you're new to Money on Tap, you want to go ahead and make sure you bookmark it. Save it. It's going to have so much inside of it that you're probably going to want to, just like Dan said, grab a pen and paper, take some notes, come back to it, give us a call, and sit down and have the conversations that you need to have around this sector of investing. And by no means will this show be complete, right? Because it is. We're talking about some stuff here that really goes deep. It's broad and it's deep in terms of opportunities and ways to process and go through this information. And you know what? If you were expecting us to go ahead and have a show that is like, the advertisement on the TV that says, I invested in the blah, 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 which is probably the Qs, right? In case you're wondering what that might look like. That's not this show. You're gonna get the information for yourself to start to ask the questions you need to have, not just go ahead and flip a switch and say, yeah, got it, done, moving on. Okay? So with that, we hope you stick around. We hope you want to dig in a little deeper with us.
Yeah, it is a broad topic, and kind of the thing that got me thinking about this as a show was the phrase that Ben's brought up a bunch of times. That I think we share on the show all the time. It's like whenever we're talking about a different investment, the question is, it's like, well, what is tech? It's almost like everything is tech, or has some component of tech, or is somehow dependent on tech. In this day and age, in particular.
I got a pair of sunglasses for Christmas a few years ago, and they played music. I was like, is this a sunglasses or is this a radio?
Yeah, everything's Bluetooth, multi-purpose.
Did I give those to you, Ben?
No.
Was that for me?
No. No, I got thoughtful gifts from other people, Seth.
Anyway, so striving to define technology, I actually just Googled it, and we looked up a couple different options, and this was a good one, I think, to kind of to build our theme off of and carry the show forward. And it says, the technology sector is composed of companies involved in information technology research and development, computers, hardware, and software. So I think, into Seth's point, well, that's a broad, definition that encompasses many, many, many companies. And in getting prepared to do this, we decided taking a look at a bunch of different companies that we know and seeing which sector they actually fell into as far as the S&P 500 is concerned. And it was, I think, eye-opening for us all. I think there was definitely some surprises for me. And one of the things when I mentioned, at the top here about, having that pen and paper ready for the show is we're going to be tossing around a lot of tickers, right? And what a ticker is, it's the 3 or 4 letter code that identifies a given investment, whether that's a stock or an ETF. So those will be kind of getting tossed around here a little bit. We're not recommending any
or a mutual fund. Sorry to cut you off there.
No, that's a good one. Thank you, Seth. Just keep in mind these aren't specific little tidbits of advice, but these are things for you to jot down and take a look at and see if it's a fit for you. If you asked me prior to our pre-show conversation, what's the easiest technology investment to make? What's the simplest thing you could do to get invested in technology? I probably would have told you, the Invesco NASDAQ ETF, which is QQQ. Come to find out about 10 minutes later, that's actually only got 50% of technology companies in it. It actually covers the NASDAQ index, the top 100 of the NASDAQ, and it's got everything in there except financials.
We talk about the Qs all the time because it's kind of the staple, of the idea of what technology is.
Yeah.
I mean, it's a common – it's just when you say, hey, the Qs, everyone's thinking technology. But when you actually break down what the technology allocation is significantly less from an official fundamental standpoint. I think that's the issue is we're talking about fundamental things because when I say things like Microsoft and Apple, everyone thinks tech. When I say things like Google, everyone thinks tech. When I say things like Amazon and Tesla, people think tech. But more of those companies that I just said are not tech, which is really funny when you think about it, right? To actually think that, when I think of consumer discretionary, I think of Walt Disney, but it's not a discretionary thing. Walt Disney is considered a communication service. Like, how do we understand the fundamental? Like, when you're saying tech, like talking about the sunglasses, at some point in time, you're like, well, it's Bluetooth in my head. Like, am I wearing them because they're sunglasses, or did I really just want to listen to music and not stick something in my ears? It's one of those things you don't know. Like when you drive a car and you think about Tesla. I mean, if I were to ask anybody, is Tesla tech? I bet you 9 out of 10 people would say Tesla's tech. It's not. It's a consumer discretionary. If I were to say, hey, Google, which, oh my goodness, Google, right? Who would think that Google or Alphabet is a communication service? Amazon. order all this stuff. We go on the computer, Amazon. Some guy shows up at the door. I've never seen him before, and he drops something off. And then the next day, somebody else drops something off. I've never seen them before either. I don't think I've actually had two same Amazon delivery people ever. I don't know about you guys, but I always think that's incredibly strange. But Amazon's consumer discretionary has nothing to do with tech. I mean, it's truly, truly phenomenal at the level of diversity that we're talking about. But Apple, Microsoft, NVIDIA, these are kind of common, tech pieces. I really did think it was interesting because I thought of Comcast and Verizon, and I'm like, well, Verizon I can see communication services, but Comcast, like the internet, but yeah, because of the TV, they are considered communication services. So we have talked about this over and over again, just like, hey, what is tech in today's world? What is that? And Dan, you were right. I think 50, let me just pull it up here just so I have the accurate piece on the Qs. The sector weighting of just buying the technology sector from the Qs, QQQ is the ticker for the Invesco technology holding, as everyone refers to it, but it's not. It's the NASDAQ 100 top holdings without financials. 50% of it's actually allocated towards the official technology sectors, 15% communication, and 12% consumer cyclical. But I think it's interesting because you have, Microsoft, and I'm listing off 50% of the total portfolio. Microsoft, Apple, NVIDIA, Amazon, Meta, Broadcom, Google or Alphabet, Costco and Tesla. So Costco I don't think is a technology. Costco, okay, 1 out of 10, I'm definitely sure that's not a technology. But most of those are actually outside the technology space, which is pretty incredible when you start thinking about how its holdings are. And then you say to yourself, well, is this diversified? And it's really not. It's just the NASDAQ 100 holdings that are non-financial. That's why it's so confusing, folks. If you can understand the nerd show here that we're talking about, what is technology? I mean, everyone's asking themselves, anything you buy has a computer, a hard drive, your cell phone. Dan, you made the point earlier, how many phone calls do you take over how many times you use it to surf the web or do whatever?
Yeah, I think actually making a phone call or receiving a phone call is probably third or fourth or fifth even most common reason I pick up my phone. I mean, it's web surfing, texting, streaming.
That's why you don't answer my calls. Unbelievable.
I don't even turn the ringer on.
I know my ringer's
calling me. I don't know.
Yeah, if you leave your ringer off, you've proven the point.
Great points, all of them. It's fun to think back to what technology was and what it is now and what it's transforming into. And there really is nothing like it in the universe of investing. It's ever changing. What it used to mean hardware, and then it meant hardware and software. And now it's completely transformed beyond that. There's the R&D of it. And it's got, technology really has become, like you were talking about, all these diversifications within the sector itself. So there's nothing quite like it, changing faster than ever, still continuing to change as much as it does. To really invest in the space is an opportunity for one. It has great long-term growth. The stories inside of the sector have great long-term growth. There's probably no other sector that you can really take a look at in increasing the returns and building a portfolio faster than pretty much most of the other sectors. And so with that, of course, why wouldn't we not get exciting? And the other side of that as well. With those kind of changes, it can completely flatten your portfolio faster than anything else out there too, or send it south faster than anything out there too. Because let's take an example. If you were to be investing in RIM, which was do you remember the BlackBerries, right? Mm-hmm. Talking about phones, right? If that was your greatest play inside of the tech space, you are so sad today that that's all you were looking at for the performance and growth that you thought you were secure in getting inside of a sector that was growing as fast as it is. So staying on top of that, staying inside of that, but in ways that you experience all that it has to offer, which certainly some of that will be some downside, but also what is the upside inside of that? So we're really excited about that. Yeah, Ben?
Yeah, I was just thinking, as you're talking, Seth, it's kind of funny. I was saying this at one point earlier with you guys. If we were to rewind to the 80s or 90s or whatever, even 70s, we could probably define tech, and everybody would probably be on the forefront of getting 9 out of 10 right instead of 9 out of 10 wrong. Just because it was like, hey, here's a computer. Oh, that's IBM. Okay, tech.
Right.
Right. Okay.
Yeah.
Here's Microsoft. Yeah, they do software. Okay, tech. It wasn't a huge space, right? And technology has become interwoven at a level that makes this very confusing. And I think one of the things I want our listeners, at least this is one of my perspectives, I think we're all kind of on the same page here, but I really want to kind of pull the web out of, the technology presumption and get people into.
Is that a play on there? Was pull the web out?
Pull the oh yeah, I wasn't even, no, it wasn't, but it's really good. We're gonna have to quote that and patent that puppy. So I want to pull the web out of that, and I was thinking very spider-like here, and really help people get a pure technology play. Like if you want a technology space without, because we talk about this, and I don't think our listeners really quantify how much this really impacts their portfolio. But when you have, like, if you start buying, the Qs in your presumed technology purchase, and you realize, oh, I have 3 things that aren't in the technology space in there, or 5 things, like, now all of a sudden the underlying stocks in those ETFs against maybe the other holdings you have, all of a sudden create you overweighted in something. And you may not really have the technology play you're looking for. And I think what I'm really excited about is actually not just breaking down technology today for our listeners, but breaking down the subsectors of technology. This is where the nerd part comes in. This is the subsectors, so you can actually pinpoint an area in technology that you really want to get exposure to really you think, hey, you know what? I think this space is going to be incredible. And so therefore, how do I get exposure to that? And that's what I'm really excited about with this show and talking about technology, is that pure play.
And I think that's the beauty of investing these days, and with the kind of rollout of the ETF, as a comparative to the kind of wide, large space in mutual funds, is that when you begin to realize what each underlying stock investment is in any of these kind of broader investment baskets, we have the ability today to fine-tune that to such dramatic scale. I mean, get really, really granular into a certain sector of an industry, but at the same time not have to pick the single winning stock. And I think that is the exciting part of where we're at today. And I think those are the things we want to highlight in this show and give everyone a little guidance in terms of, how do you narrow that field but still spread the risk out over a specific element of a sector with, again, not having to make that one winning stock pick and still do well.
All right, you're listening to Money on Tap. We're going to take a quick break. In the meantime, you can reach us at 855-226-8551 or info@yourmoneyontap.com. Don't forget to subscribe while we're taking a break. And while you're at that, send us a little love letter, whatever you like, at info@yourmoneyontap.com. Yeah, because we got some Money on Tap gear that we want to send your way too. All right, we're going to take a quick break. We'll be right back with Tech Talks and how to invest in tomorrow's Titans. We'll be right back. Hey, Seth Krussman with Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors, we're here to help you. Our team of experts will provide professional, personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today and schedule your free consultation. Looking forward to seeing you there.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Yes, Tech Talk, how to invest in tomorrow's Titans, referenced RIM, BlackBerry, right? Some of the stuff is great because it's just off the cuff. we're talking about stuff. We didn't prep that conversation, or we just kind of, as we do this, you guys, the secret in the sauce is that we really don't prep that whole conversation. We're not scripting. We're just talking and having a great time, and including you in this conversation. For those of you that like that, wonderful. Thank you so much. We appreciate all the comments and shares and likes, and you guys sending, this to your friends and family that just want to get included in, what we're doing at Money on Tap at Brayshaw Financial Group. So, one of the things that we're talking about right now, is risk and highlighting some of the risk inside of investing. It's a fair conversation to have when you talk about tech. When we were going through kind of the evolution that, Ben, you were talking about, hey, you owned a computer, IBM, or maybe it was an Apple. That's what we had in our elementary school.
I had a Tandy 1000
computer
TX.
lab, a Tandy, IBM, pretty much, right? Commodore 64. You remember some of those, but inside of school, it was the Apple IIe that was really the revolutionary thing that all the people were now able to afford. Not us, but apparently people at that time could afford those things. And we were like, I remember the typewriter coming out when it was a report time for school. And when we got, anyways, so the
sticking whiteout. I was ran out of whiteout tape.
The standalone word processor, like what kind of dinosaur is that thing?
Yes. So what happened for us in the 90s when we were in school is, for one, we got an email and everybody went, oh, well, what's this for? Why would I need that? We're just going to go ahead and mail stuff, right?
I remember that thought too.
Yeah, we got emails, and we had these little computer labs that people were learning to do some simple programming and learn to type. But the internet came along, and most of us do remember our very first experience with the internet. And I mean, it was cool, but nobody was like really grabbing a hold of this. Most of the time, weren't really grabbing a hold of this, seeing the future. But then technology really did start to transform. That's one of the things I think in terms of tipping points and exponential growth. We experienced those things inside of this sector of the investing sector. One of the stories, and many of them do come to mind, but one of the stories was the RIM or BlackBerry story. Now, if you remember a BlackBerry, there was this, Palm Pilot, right, or the Palm Trio, which was the company that was really on the forefront of cell phones and getting the keyboards out and being able to actually engage on the internet, kind of. And then BlackBerry had the system that took over because there was kind of the end-to-end safety of it, where that was a big factor, and so everybody's company had the BlackBerry. Huge growth story. And if you were a part of that, travel along 2004, you're at roughly $22 a share. And in 2008, we're topping out at around 132. Huge story. But today, right, if you take a look and you want to go buy it, you still can. But you're looking at roughly like what, $270 a share. And the funny thing for me is I take a look at this stock is today you can go ahead and look at a headline that says BlackBerry surges 16%. As BlackBerry joins the Roaring Kitty rally, which is one of those meme stock kind of stories inside of our investing today. So yeah, maybe you can. I mean, 16%. Nobody's going to say bat an eye at that. That's great returns. Why? But in terms of a real true opportunity inside of what we can look forward to, it is not the story that we talk about today inside of investing in technology, right? Those are just kind of one-offs, and that's again fun coffee table or water cooler story, but that's not where we're heading with our outcomes of what we want for ourselves or you as investors inside of this space.
Seth, you said BlackBerry went all the way up to 220. And that was $220 a share or whatever it was, but it's down to $2.
Did I say 220? I'm sorry, I meant 100, 120, 138. I think is where it topped out.
So, anyways, just looking at historicals, but there was a point in time where it was like well over 200, but it's down to $2.87 today. Like it's and it's a dead company, and it's
Apple
heavily shorted. Thank you, Google. I remember when Google and Apple and all them were announcing that they were going to create phones and like, oh, they're going to get into the phone business. Like, seriously? Remember that? You guys know what I'm talking about.
I had a Palm Trio at the time.
Yeah.
I remember it well.
I love the keyboard. I held out on that BlackBerry forever, man. I love the keyboard.
Yeah. Yeah, you were a big BlackBerry. I had a Palm too. But the thing is that I like the days when my parents would send me out. We'd ride our bikes. We didn't have a phone. Show up home for dinner, and if you're late, you get beat.
You like that, huh? You really missed those days.
Yeah, I mean, my phone rings constantly. I mean, I have to put this thing on silent, no vibrate. Like, this.
Things were simpler then.
But the problem with the risk of technology, and I think this is what we're talking about, is really the risk, is that we have these glory days of amazing stocks that have literally breakaway technology that's unforeseen, unheard of, stuff we never understood, like AI today, right? We don't even understand it. And companies are skyrocketing, rising. People are using it. They're making money with it. And then all of a sudden, somebody is more innovative, more creative, more capable. It could be a guy sitting in his garage programming right now, coming out with something that's going to make the current AI competition out there obsolete. And I think that's what we're talking about, is that technology has this huge, much bigger risk than probably every other sector, in my opinion, out there, for people getting burned on the individual space. Like, you buy an individual stock and you get burned.
It's like, I think it's the most speculative period we've been in since, guys were wandering the sands of Texas digging holes looking for oil. There's just so much risk involved in that, because the technology and the innovation and, the leader in a certain product line or the inventor of a new product line, it all changes so fast these days that you don't want to get caught behind. If you're going to invest in this realm, it is one of those things that, you really do need to be aware, read the news, follow the trends, stay ahead of the curve on this stuff to the best of your ability, because things change fast. Nobody wants to own BlackBerry now.
Yeah, no, exactly. And I think that's the piece that it's really hard for people to understand. I mean, we were talking about this off air. We were just talking briefly. It's like, well, you could almost invest in Apple and Google and, in our lifetimes probably not lose. And it's like, well, I mean, if we have a regulatory change, and we were talking about that, like a regulatory change and all of a sudden Google can no longer be on the internet in the United States of America, you don't think that that's going to affect not only all the people who watch Google, all the YouTube stuff and everything else. And okay, well, now that's got all the people that make money off of that stuff. They're not making that's going to massively impact our society. And so couldn't that happen? Yeah. I mean, look at the whole TikTok debate and whether or not that's going to, so there's just so much out there in the risk realm of owning individual stocks. Do I think that Google could be a play like that? Yeah, maybe, Dan. I don't know. And I think that's the thing. It has all the components of it's probably okay, but there's just a never without risk kind of investment in the tech space. Like, everybody can be obsolete. Like, I think it's kind of like if if there's a company who manufactures steel, well, we're going to be building buildings forever. So, at some point in time, you buy a steel company, it might really decline heavily and you lose a lot of money, but most steel companies are going to be around for probably forever, right? Google, maybe not. Apple, maybe not. And I think that's really hard to say, even though they are such huge financial titans.
Great way for us to kind of segue into, and we are going to take a quick break here in a minute, but taking a look, I think, in the breakdown of what it's going to take to be successful inside of investing inside of tech. How do you make some of these decisions? Is it a viable business model? Financial strength, innovation, relative competitive strength. And when I think of like the relative competitive strength or a durable advantage inside of an industry, I think of Warren Buffett, right? One of the greatest ever. And how did he invest? Well, he was investing in looking for durable strength and competitive advantages, markets that could be cornered and stick around for a long time, long-term growth. And he was not looking for the cheapest companies. He was looking for great companies at a good price. It's funny, actually, as I say that, what has he been doing lately? Well, Occidental Petroleum and Chubb. So he's going the other direction, as Warren will, and investing in petroleum, right? That's where he's been going. But he did eventually step out of the I'm never going to invest in technology model, which was what he was for a long time, and bought what? Apple, right? That's been huge. And as we understand more about Apple, we can see why he would do that. So we're going to take a quick break, and cannot wait to get back with you on Tech Talk, how to invest today in tomorrow's Titans. Don't go anywhere. You're listening to Money on Tap.
Hey everyone, Dan Mickelon here with Brayshaw Financial. Looking for a hassle-free way to invest? Look no further than Brayshaw Financial Group. With Brayshaw Financial Group, you can start investing with as little as $100, enjoy a user-friendly platform with a diverse range of investment options. Visit Brayshaw Financial Group and start your investment journey today. Brayshaw Financial Group, investing made easy.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben, Seth, and Dan.
Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are in Tech Talk and how to invest today in tomorrow's Titans. Technology, massive sector of the investment space. When you take a look at the S&P 500, it's broken down into 11 sectors. Technology is one of the largest today that covers so much ground. And as we've, talked about so many of these companies that you would think, oh, that's technology, right? The Amazon, no, consumer discretionary, or several others, Google, you name it. They can be pulled into some of these other segments of the S&P 500. But right now we're talking about technology. And within the technology sector, we traditionally had some understanding around that. And as we started the show talking about how this has not only widened the space, we're going to get a little more expanded on that. Where does that take us?
Well, when it comes to technology, there's always kind of been three subset sectors in technology, and you'd invest in software, hardware, or network data processing, which is
network dating. That's definitely one of those.
Network dating is definitely using software, network or data center stuff. The cloud world per se. We believe, and we all have. We've talked about this. There's probably way more number of true underlying subsectors of technology inside this. Those are the three primary that have existed forever. But we actually think it's really expanded into 6 hard sectors that may expand into more. But those sectors are pretty simple. We still have the software, the hardware, the network, data, Seth, or the cloud. We still have those 3 sectors. But we have this other sector that everyone talks about is the semiconductors, the semi. And then we have cybersecurity has become kind of its own sector in the technology world. And then that beautiful new thing called AI, which everyone seems to be talking about and for good reason. And I say we, but I think, Dan, I think you really kind of took ownership of that, was just saying it's kind of what once you get ETFs are those investments that are culmination of multiple stocks. So you buy an ETF and you have anywhere from 50 to 100 or 200 stocks underneath sitting there. And when you buy an ETF, it is very specifically and intentionally invested in a specific realm. So if you buy a gold ETF, it's going to have gold miners, gold refiners, it's going to have gold transporters. Everything's going to be gold related. Well, you can buy ETFs that are very specifically cyber related. And I think that's really where I think is a really good litmus test to say if an ETF is coming out with a very intentional subset of a sector, it probably is a subset sector now at that point.
Yeah, it's kind of the tail wagging the dog, but is there a sector out there to invest in? Well, as soon as the product exists, there is, right? And as soon as someone out there is taking the opportunity to bundle those stocks that are very specific to that topic, well, now we kind of have a new sector, or at least the opportunity to invest. I mean, you can mince the words here back and forth, but that product exists that allows investors to get very, very narrow and to take a calculated risk on something very, very specific. If you look at technology as a whole, I mean, we started this conversation with QQQ, right? We presumed, well, that's the technology ETF, the broadest one you can get into. Lo and behold, it's actually really 50% of true tech. All right, if you want an ETF that is broad-based but is really all technology, now you're looking at tickers like VGT, IGM, IYW. So to get that notepad out, right? These are the things we're talking about. So those are ETFs that you can invest in that are truer to the definition of technology than is QQQ.
From a broad scope.
Correct.
From a broad scope.
That's covering all these 6 sectors, subsectors we just came up with, and anything else that truly meets the definition of technology. So that's your, I think broad scope's the right word. If you want to invest in technology because you believe it's the way to the future, but you don't want to dig any deeper than that, that you're not really looking to take a bet on a specific product or super subsector, then that's the way to go. Those 3 tickers are opportunities for you to just cover technology as a whole. But then when we get into the 6 subsectors we've identified and we're talking about focusing in on here, I mean, the hot one of the day, right? AI. Everybody's interested in AI. That's, every conversation I have with, non-investors or people who are just kind of feeling their way into the investment world or they just want to ask something of a financial advisor. I mean, by far and away, the most frequent question these days is, without a doubt, how do you get into AI? Tell me about AI. Where's the AI investment? And that's, there's lots of options out there, easily found out there, but one to take a look at, potentially is CHAT, which is the Round Hill Generative AI and Technology ETF, CHAT, CHAT. All right, so that's an example of getting really defined.
I think one side, I was just thinking, Dan, with the like IYW, it's like you have to go to Yahoo and really evaluate, like how true these are too. Like we're not recommending any of these tickers. This is just trying to get people to more intentionally structured focus if they want to sector invest, like how to really like hone in and try to get as close as possible. But it's funny when you go to Yahoo Finance and you just click on the holdings. This is a real litmus test because what you can say is oh wow, it's 89.58% technology and it's still got 10% in roughly communication services, which is Meta and Google, which are not officially technology. So it's just really interesting as you're breaking down this stuff that you get yourself aware on what your underlying holdings are because, again, this has 16% of its allocation is in Apple. 17.5% of the allocation in the IYW is Microsoft. So
it's very heavily concentrated.
That's extremely heavily NVIDIA is 15%. So every time you buy this, that's the allocation you're making. And if all of a sudden you're buying the Qs and you're buying this and you're buying that and the S&P 500, well, trust me, the overlap in your top 10 stocks is going to be astronomical. You might have, 30% or 25% in just Apple or just Google or just NVIDIA. And if the bubble on NVIDIA pops, well,
you'll feel that.
Yeah.
I was just looking at some of the tickers that you were talking about there, Dan. And one of the things I love inside of this sector today is to be able to look at how mature it's becoming. Used to be like the tech, like we're thinking 2000s, right? There was the tech bubble. We've gone through that. And then we went through the 08, 09, which was financial crisis. But all of these were affected inside of that. And today where we're at is we've had those companies that have survived, or there's even newer ones now, but they're very developed. And one of the signs of their development and maturity is a dividend. And as part of what we talk about a lot inside of our investing philosophy is really being in front of the macroeconomics of an aging population and what are some of the things that they're going to be needing. They need dividends inside of their portfolio to support income. And if you are looking to try to be a part of that story, but still want to participate in the tech opportunity, growth opportunity that tech has traditionally offered, yeah, there's a thematic stock, TDIV, that is based off of technology and still offering dividend. And it's not, dividend like maybe some of your traditional dividend stories are, as high as some of those can go. But it's still an interesting way to try to participate, yet potentially protect some downside in a segment of the of investing that has traditionally been very volatile.
Yeah, I think as we think on segments, and that's good to bring up, Seth. If you're looking for income, this high growth tech space is probably not the play. But if you're looking for growth, one of the other hot topics has been over the last couple of years has been the semiconductor space. It's been absolutely red hot, and they're building the chips. I mean, you could call that hardware, but semis have become truly their own element within that space, no doubt about it. Even though you can physically touch it. But some semi tickers to take a look at would be like SMH, SOXX.
Yeah.
These are two of the kind of brand names in that space. So, if the chips is the angle you want to play, there's a good opportunity there.
I know we talked about cyber. I know, cyber, CIBR, that's a First Trust one. There's the hack. There's the iHack. There's, there's the Vanguard, one. There's a number of different cyber. I mean, cybersecurity, I think we all know is just, it's just a matter of time before everyone gets hit.
Yeah. And these companies, they have to buy it to protect themselves,
yeah.
whether they're under threat or not. I mean, they have to buy it. So the software sells.
Right.
They buy it.
And the best software sells the most.
Right.
So at some point in time, somebody's going to hack a new way, and one of these companies is going to have the new way of protecting against that, and everyone's going to shift over there. And so it's complicated. And
to that point, that hack HACK ETF shows up as a leader not only under the cyberspace, which is what it's designed for, but it's a software product, and it shows up in the software ETF space as well.
So you have to watch that overlap, and I think we're not recommending you go out and buy any of these tickers at all. We're just trying to give you some ideas that you can get granular if you feel like there's an opportunity in a specific subset. Like you're like, hey, I want to get into tech, but I really like cyber. Or, hey, I want to get into tech, but I really want to get AI. I really don't care about the Apples or whatever. I have plenty of that. I own the stock. Or, how do I get exposure without getting burned? And I think this is the best conversation we've had in a long time about really risk mitigation, is saying in technology, it's so much better not to just start selecting, the big bang, hoping you get the next NVIDIA purchase, and really just looking at the idea that I can get broad diversification in an ETF in a space that I know should do well over time in my mind. And I'm gonna buy this ETF that gets me into cybersecurity. I'm gonna buy this one that gets me into semiconductors. And let the manager figure out where the money's going to go.
Yeah, the cloud trend, right? Your actual storage, where's it all going? These massive plants with huge infrastructure and cost, or is it all getting stuck up in the cloud? Mm-hmm. And the trend is the cloud, without a doubt. And a couple of good cloud plays to consider would be FCLD and IDAT, right? That's the iShares 5G and Cloud ETF. So if that's your play, if that's what you're thinking about as well, AI is going to create all this knowledge. It's going to draw information. How does it work? Well, it's fed by the cloud, and then whatever it produces gets stored in the cloud. So there's a couple of cloud plays, and then we talked about hardware, which seems like the dinosaur in the realm here, right? That's like the oldest throwback version of the technology space. But there's an ETF there, XTH. You can take a look at. So the technology is one of those large sectors that can truly be broken down, and with the evolution of ETFs, you can get so specific. It's just a wonderful opportunity.
You guys, as we're talking about technology, all these different areas inside of technology, I cannot help but bring to the table a problem. And a real problem for technology is energy. Because as we are now going into massive amounts of data consumption and chips, yes, being able to process such huge amounts of information, but requiring still, until there's the next one that doesn't or requires less energy, there's so much required energy. And with AI consuming so much of the space now in these data centers and what it takes to actually run the AI world, it's an energy equation. And it is one that we'd love to talk to you about as you're going through this process, in how to support you and being successful in your investing. That's what we're about here, Money on Tap. Thanks for joining us today and having some fun with us as we have been in our tech talk and how to invest today in tomorrow's Titans. It's an honor to be here. Thank you so much for spending the time with us. Be successful in your investing, and we'll see you here next week.
All season long, it's Money on Tap's Summer Sector Series. Each week exploring a different high-growth industry, analyzing major players, market trends, and emerging opportunities. Join us again next week for more smart, sizzling investment opportunities here at Money on Tap. The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of Osaic Wealth Incorporated. Osaic Wealth Incorporated and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire 03110, and can be reached at toll-free 855-226-8551.
Well, bye.